Accepted versus rejected add backs. What's the real truth in EBITDA? Some individuals are not going to be thrilled about this, but the realities of commercial banking are what we're bringing to you. Earnings before interest, taxes, depreciation, amortization. That's what EBITDA stands for. In banking, what's the reality? Interest, depreciation, and sometimes officer compensation. Taxes aren't typically an add back. I actually have almost never seen any institution or financial lender consider taxes as an add back. Ordinary business income is your taxable net income as opposed to M1 if you keep looking down. If you're an 1120, 1120S or 1065 partnership, that's where you're going to see the M1, your book net income. But the taxable net income, your ordinary business income, they're almost never going to add taxes back. And that's because they're almost always already calculated. That's how they view them. Unfortunately, people think because of earnings before interest, taxes, depreciation, amortization, both amortization and taxes are part of the add back. This is just a general misconception. I'm telling you this after doing $1 billion in transactions in commercial banking across thousands and thousands of deals. It's just not an add back, unfortunately. And I fought and argued with several institutions over the many years I've been doing this. It's not considered. There's a 4562 again, statement of amortization and depreciation. That's where amortization usually lives, and more of that depreciation breakdown expense. The depreciation that institutions are going to add back are on that first page, that first 1120, 1120S, 1065 page, or Schedule C if you're a sole prop. So if it's not on, just like classification of expenses, like we talked about with P&Ls, if it's not on the depreciation line item, specifically on the depreciation line, they're not going to add it back. If it's not on the interest expense line item, they're not going to add it back. Amortization is lower in the tax return. They almost never scroll down that far. They will go to your Schedule L, which is your balance sheet on your tax return. Most banks will, some won't. They're just going to look at revenue, interest, depreciation, officer compensation, sometimes it depends, and they're going to look at that net income or net loss. That's where they're looking to see if you fit a payment or not. Negative net income or net loss indicates negative repayment ability per the bank. Although it seems silly, of course, because at times you're showcasing, historically, you've covered 5 times as much as the debt service. Debt service coverage is based upon true net income plus these actual add backs in banking, not amortization, unfortunately, not taxes. So again, counterintuitive. I'm sure you've heard EBITDA before. If you haven't, EBITDA, earnings before interest, taxes, depreciation, amortization. It's the earnings before that, meaning what was it before I expensed those, before reducing and subtracting interest, taxes, depreciation, and amortization. But really in banking, it's what is the net income before I removed and reduced interest, depreciation, and again, sometimes officer compensation. How do you find out and know what you're adding back? You've got to ask. It's a fair question to ask. Well, what are you adding back? I need to better understand how you're underwriting. Are you considering my officer compensation as an add back? Are you looking at my interest depreciation expense? You would be shocked at how many applications get declined every single day where banks miss it because they make a manual error. Because if it's not in the right place, exactly as they expect it and how they want it to be, they won't consider it. Know your add backs, know what aren't your add backs, understand that, unfortunately, in business finance, taxes, amortization, not commonly add back.